Good afternoon, ladies and gentlemen. Of course, I want to say good afternoon to those of you joining me here on the East Coast. It is just after 12 noon Eastern Time. I want to say good morning to those of you joining us in the Central Time Zones, the Mountain Time Zones, or the Pacific Time Zones. And of course, good evening if any of you are joining us from across the pond in parts of UK or parts of Europe. And of course, good early morning if you're joining us from parts of Asia or Australia. Welcome to today's presentation on ideas on when, how, and why to manage your covered call positions. Okay? We're going to take a look today at different management techniques, but more, we're going to try to focus on managing based on your trading plan rather than rolling for the sake of rolling. Now, naturally, the covered call position is a great way to generate income on a regular basis. You already own stock in your account, or you're looking to buy shares of stock. And of course, we can rent out the stock, is what is commonly taught, on a weekly or monthly basis, selling call options against it. Now, as we know, those of you who have been trading covered calls for an extended period of time, maybe if you've even just been trading covered calls for the past month or two, you know that not all positions will make money, and in some situations, large losses can be realized, and that's what we want to look to avoid. Not only avoid it, though, but what to potentially do in the case that an unexpected large loss occurs with our covered call positions. Now, very basic, and I apologize if many of you are beyond this, but we know that there are two basic outcomes of selling a covered call against our stock. Number one, at or near expiration, stock's going to be above the call strike price. We're going to get assigned, deliver our shares of stock, we make the maximum profit. Or the stock falls, it's below our call strike price at or near expiration. That call expires, we still hold the stock, and we can look to roll or sell another call the next Monday or the next week. Now, for those of you that are trading covered calls for an extended period of time, you know that these are the most basic, obviously, and most unlikely outcomes in your portfolio. You're likely going to manage or adjust the position prior to expiration. Okay? Now, outcome number one, assignment. If this is your trading plan, I hope this happens often. When you get assigned, that is the maximum return on a covered call position. You take the profits. Maybe you're not married to the stock. You weren't looking to hold it long term. You've made your goal for your weekly or monthly trade, and you're going to open new positions the next Monday or the next Tuesday following your trading plan. But even if you go deep in the money and you have a large percent to break even or downside protection, we know that we're not going to be assigned on every position. Some are going to decline in price and may decline suddenly overnight or in the pre-market hours. And we're going to need to roll down to hedge the losses, but that of course brings up the point that we may risk being locked into a loss. And if the stock does move up, an in-the-money covered call investor may look to roll the call up to take advantage of higher premiums as well, but you don't want to roll for the sake of rolling. Okay, now, if you sell out of the money covered calls, meaning that I maybe purchased a stock at 30 and I sold the 32.50 call 1 month out for a little bit of premium, on a basket of core stocks, I'm trying to develop a extra dividend-like income against my position, we would want the call to expire worthless. Or hopefully if the stock falls in a small percentage, we may be still at a small profit or a small loss, and you'll continue to sell those out-of-the-money calls on the stocks you want to hold for an extended period. But as before, things can unexpectedly and suddenly go against us. If I sold an out-of-the-money call, in addition to perhaps experiencing an unexpected large downturn in the stock overnight or in the pre-market hours, we can see a large pop in the stock. Just the other day, I believe it was Mondelez, gapped up 5 or 6% overnight because there was a rumor that Kraft and Heinz Corporation, now the Kraft and Heinz Corporation might be interested in buying Mondelez. Well, now they've kind of said, no, that's not really happening. But if I had sold an out-of-the-money call and it gapped up, I might have wanted to roll that call to stay out of the money so I wouldn't get assigned if the stock continued its move. Of course, that all depends on your trading plan. But with the out-of-the-money call, if the stock gaps down, we're almost in a worse situation simply because we didn't generate as much premium as we would have expected with doing an at-the-money or an in-the-money covered call. Now, before we go any further, let's just get to know each other a little bit more. What I'd like to know, those of you in attendance today, about how many covered calls are you trading per month? Now, are you trading maybe 1 to 5 covered calls per month? Are you looking at maybe 6 to 10 positions per month? And I'm not talking about rolling, just the standard stocks you own in your portfolio and calls that you're selling against them, whether it's 1,000 shares of a stock or 500 shares or just 100. Just about how many stocks are you selling covered call against in your portfolio in a given period? And 1 to 5, maybe 6 to 10, 11 to 15, 15 to 20, or more than 20 covered call positions. I'm going to leave each poll open for about a minute. We've got over 70% of our audience already voted in this particular poll, so I'm going to leave it open for about another 15 to 20 seconds here. All right, let's go ahead and close that poll. We only have, oh wow, it's an even split now of the 77% of you that voted. So let me go ahead and close the poll, share the results. As I mentioned, 50-50. 50% of you are doing 1 to 5 covered call trades per month. Another 50% of you are using 6 to 10 covered call trades per month. All right, let's follow that up. And I know that many people don't like to answer this kind of question, but how would you rate your covered call return over the last 12 months? And if you've only been trading for 2 to 3 months or even 1 month, how would you rate your covered call? Are you making the 3 to 5% per month that you were promised, maybe from taking a weekend course, paying a couple $1,000s? Are you averaging a good annualized return of maybe 15 to 20% per year? A little bit less than 3 to 5% per month, but still positive. Are you pretty good? You're positive for the year, but you're not above that 10% return on the position? Are you currently treading water? You know, just about at break even when you factor in your commissions and everything else. Or are you looking for a different strategy due to the losses on the covered call position? Okay, so we've got about 60% of our votes in. Some are still rolling in. That's fantastic. Thank you all for answering the poll. This is pretty interesting. All right, so let me go ahead and close that poll now, and I'll share the results, of course, with everyone. It's good and bad. So 11% of you say you're doing great. You're making that 3 to 5% return per month that you were promised. 33% of you are doing good. You're still making 15 to 20%, not quite that 3 to 5% you're promised, but you're still doing well. Another 33% of you are positive for the year, but not near 10%. Okay, so you're a little bit above treading water, but you're not getting as close to returns. And 22% of you are looking for a different strategy due to the losses on the covered calls. Okay, well, hopefully today's presentation will help you all enhance your management techniques for the covered call position. For the 22% of you, I do have a solution for you as well. 2 different approaches that you might want to consider. We'll make sure that we get to that at the end of the presentation. I didn't prepare any slides for that, but I do have an answer for you as well. Last but not least, last poll of the day, I absolutely promise you. I just want to know, what is your trading plan for managing your covered calls? Okay? Do you have a strict set of rules if the stock moves up or down a certain percentage? Do you look for assignment and only adjust the losing positions? Do you always roll prior to expiration to keep the calls OTM, or maybe keep the calls ITM depending on your position? So you roll prior to expiration always. You don't have a plan, you just roll with the market. And you have a plan, but it has hurt more than helped. Okay. I apologize, ladies and gentlemen, excuse me. So we've got about 67 of our votes in, 67% I should say, and I'll leave the poll open for another 5 or 10 seconds. I guess I could say this is what I expected, but personally, I expected the outcome of this poll to almost equal what we saw for the results in the last poll. Let me close the poll. Let me share the results with everyone. So no one says they have strict rules for managing a covered call if the stock is up or down a certain percentage. Honestly, I expected that to be sort of with the last poll where maybe 5 to 10% of you did have strict rules. Now 40% of you look to be assigned on your positions that are up in price or above your current option strike and only adjust the losing positions. Okay, that makes sense. It's a good approach. No one's rolling prior to expiration just to keep the calls out of the money. Okay, and 50% of you, the majority of you, you don't have a plan, you just roll with the market. Well, that can be beneficial, but because it's always good to wait, and it's always good to try to wait for the market or your specific stocks to show their hand and not overtrade. But in some cases, that might end up hurting you more than helping you. And 10% say that you have a plan, but it has hurt you more than helped your trades. Okay, so let's hide that, and let's move on here as well. Now, before we begin, I want to clear up two things about how Ernie, myself, and the rest of the Power Options staff approaches covered calls. Number one, many gurus out there will claim that when you're trading covered calls, you don't care if the stock goes down. We know at least 2 or 3 services that charge a couple $1,000s to attend a weekend seminar to learn how to trade covered calls, and they're adamant about saying that they don't care if the stock falls when you're in a covered call position. You're just going to continually sell calls week by week or month by month to get income. Well, we don't really follow that rule. We absolutely care if the stock falls because we're in this to make money. And making money on option premium, let's say at a rate of 1.5% to 2% per month, does not help me if my stock is down 15, 20%. I'm looking at my total portfolio. Many of you are doing very well. I'll be honest with you. 44% of you are probably averaging over 15 to 20% annualized return with your covered calls based on the last poll. And that is fantastic. But I still want to see what we can do here to enhance our adjustments. But I do personally care if the stock falls. I'm not one of those that says, hey, if the stock falls, just keep selling calls. You'll keep generating premium. Eventually the stock will come back. Nah, I've had too many stocks that never came back, not only in covered calls, but also in collars and married put positions. So yeah, I'd actually care if I was in that position as a covered call. And number two, rather than approach this content based on what the stock does or does not do, which is going to be our main focus for an adjustment, but rather than focusing on that, I want to address the management based on your individual trading plan. And if you don't have a trading plan, you're going to see some conceptual ideas here what a covered call trading plan might be. Okay? Now, let's talk about trading plans. And we're going to look at the most basic idea of a trading plan of a covered call. Many of you are in covered calls because it's a way to generate regular income. And in addition to that, it's touted as a conservative strategy where you can generate income and have some protection on your position. But just like any other option strategy, whether we were talking about bull put spreads today, bear call spreads, iron condors, or other positions, there's essentially 3 ways to approach it. What one might consider a conservative covered call trader, a neutral covered call trader, and a speculative or aggressive covered call trader. And these are the 3 categories that they fall into, in our opinion. In-the-money covered call investors, you're going to sell an in-the-money call below the current stock price, hoping to be assigned, of course, and you're going to look to make a small premium. That'd be considered conservative. You have a higher downside protection. The stock can fall further before you start losing money on the position. An at-the-money covered call trader I'd consider to be moderate, slightly aggressive. You're looking to maximize the time value premium by selling calls at the current strike price based on the at-the-money bell curve, of course, and you've got maybe a 50-50 probability that you'll get assigned on the position and make the maximum return. And then our out-of-the-money covered call traders might fall into 2 groups. It is the most aggressive type of a covered call investment, and you may be doing it because, again, you're holding a basket of stocks in your account. And it might not be the only option strategy you're doing. Maybe you inherited stock, you have stocks in your portfolio that you've had for an extended period of time with a much lower cost basis than the market's offering right now, and you're using out-of-the-money calls to generate a dividend-like income. Or you're extremely bullish and you're trying to get the maximum return, speculating on the stock moving up to get the intrinsic value between where you purchase the stock and your higher strike price and keep that little premium that you got for selling the out-of-the-money call. Okay, this is a basic view from yesterday, 12/15/2016, on Apple, which at the time was trading at about 115.82. So let's just call it 116 for the sake of the argument. But in general, and I went out to the monthly series to January 20th, so we didn't get looped into all the dollar strike differences and everything like that. But our case studies and our examples today will be looking at dollar strikes for weekly options. But the rules we're going to discuss will apply to any form of covered call, whether you're selling 1 month out, standard expiration on a regular basis, you're selling quarterly, maybe 3 months out to get a higher return and more protection over the course of that time, or if you're selling shorter term weekly series. But what we see here from the power options chain is we'd consider the 115 strike to be at the money, closest to the current stock price of 115.82. Does the at the money offer the highest premium? No. At $3 roughly between the bid and the ask, it's half of the in the money 110. Of course, we'd be giving up extra premium. But what we want to focus on here is the at the money range, the downside protection, and the percent if assigned. These are mainly the 3 columns with, of course, the probability that a covered call investor will focus on, in my opinion. So the at the money option, and this is 36 days out, is going to give you a reasonable downside protection. You can expect about 2 or 3% with about a 2% maximum return if assigned and a 2% time premium. If we go deeper in the money, now we get a better premium. But remember, more than half of this premium, this $6.60 we could collect, $5.82 of that is intrinsic. So we're making a much smaller time premium. We have a much lower percent if assigned, and I don't know if that would match my trading plan, that 0.7%, honestly, for a 30-day trade. I'd be looking at that for maybe a 14 or 15 or 20-day trade, I should say. But you get a better downside protection. And we see here in the probability, we're almost close to an 80% probability that we get that return. So we're giving up a little bit of return for higher probability. And you're out of the money, still collecting a reasonable premium, but it's almost reverse of the in-the-money covered call, isn't it? Where the in-the-money covered call gives you a 5 or 6% downside protection and about a 1% or 0.5, 0.7% max return. The out-of-the-money gives us just a 0.8% downside protection with a 4.5% return. So I'm not going to tell you which one I feel is best. Honestly, I will say that I focus kind of in this range, at the money to slightly in the money. We'll talk about that a little bit later as far as my trading plan. What we're focusing on today is management techniques, whether you're in the money, at the money, or an out-of-the-money covered call trader. And a lot of the ideas for management will follow the same plan. Okay, let's follow the same management and trigger points. Now, a trading plan, if you're going in the money, you're willing to accept a lower maximum return, around 1.5 to 2% for monthly, just under 1% for weekly. Apple actually has a much lower volatility, so that monthly option with the in-the-money call was under 1% as well. But you're looking to have a better probability of assignment. You're willing to take the lower return to focus on a range of being assigned 70% or 75% of the time, hopefully only having to manage 20 or 25% of your covered call positions. And you have the benefit of a higher downside protection. Where we see maybe about a 7% downside protection. What does that mean? It means you collected 7 to 8% premium against the stock, so the stock can actually fall 7 to 8% before you're losing money on the position. And with a weekly option, you'd expect maybe 2.5% downside protection for your 7, 10, or 14-day out trade. Okay? So is that necessarily better or worse? Well, again, it depends on market conditions. Over the last 3 weeks, we've seen the market be consistent and moving up in price. So I would have rather been at or slightly out of the money over the last 3 weeks. But if we have a correction in the next 2 or 3 weeks going forward and going into 2017, I'd rather be in the money for the better protection. So market conditions do matter, and market as a whole, because even if your stock is strong, has good earnings, has good growth, the market as a whole is pulling everything down. you're going to want to be defensive. Now at the money, I mentioned, of course, you have the highest time premium. You've got a strong return if assigned, the maximum return. It's going to be around 3% for monthly, maybe around 1.5 if you're looking at weekly series as well. Now you only have about a 50-50 shot of being assigned based on probabilities. Of course, it's definition of at the money. Probably looking at a delta of around 0.5 or so. But it'll still offer you, because of the at the money bell curve, it'll still offer you a strong downside protection. Or you could still have a 4% downside protection for a monthly series and maybe 1.5 for a weekly series as well. And then, of course, the out of the money. We could consider this speculative, but again, many of you may be just trading this against core stocks. Either you don't want them to get assigned at that much lower cost basis for tax reasons, or you just want to hold the stocks longer term, continue the dividend-like income. And again, you'll see a maximum high return if assigned because it incorporates the intrinsic gain on the stock to the strike price plus the premium, but you're going to have a much lower probability of assignment and little to no downside protection. Is one better than the other? Well, it depends on your stock selection process, the market conditions, and again, the management techniques. As I mentioned, I prefer to look at or slightly in the money with the covered call positions that I trade occasionally, and I'd be at or out of the money with my cash secured naked puts as well. And if you look at the picks of the day on power options for covered calls, both the standard expiration and the weekly expiration, you'll see that Ernie's historical testing to develop the picks of the day found that the slightly in the money calls in both weekly and both the standard expiration, slightly in the money covered calls yielded a higher return over time because you can withstand more decline. All right, but let's get to what we want to talk about today. Why all this talk about a plan and not management? Because I think your management approach should reflect your trading plan more than rolling for the sake of rolling or panic rolling. Let's be honest, there are many ways that you could potentially adjust a covered call with all the options available. We're going to look at something we call the stock repair technique later on in the presentation to manage an out-of-the-money covered call that has really declined against us. All right? But you don't want to just roll the position for the sake of rolling. It has to stick with your trading plan. An in-the-money covered call investor may look for different targets and different exit prices to roll up or roll down than the out-of-the-money covered call investor. Let's take a look at an in-the-money covered call setup and management. Okay, let's take a look back to December 8th, 2016. Goodyear Tire was trading right around $31.89. That was the closing price. If I'm an in-the-money covered call trader, as we mentioned, we're probably going to look to focus on positions that match that in-the-money trading plan. Now, we could sell to open the December 23rd, so it's roughly 15 days out in time. So we're going 2 weeks out in time. So we could consider this a weekly trade, not really a monthly trade, but the rules we're going to talk about will kind of apply to both situations. But the 31 strike call was trading at 125. Now, again, this gives us only 36 cents of time value. Yes, we're collecting 125, but remember, we're giving 89 cents of that back for the intrinsic value. We have a decent 3.9% downside protection, and we, of course, have a 1.2% if assigned for a 15-day trade. It's a pretty good trading plan. Remember, we talked about weeklies with an in-the-money covered call might be around 1% or so, just under 1%. So 1.2% for 15 days, still within that range. And we have a 70.8% theoretical probability of being assigned December 23rd expiration next week. Okay. So here's our covered call position for GT, and as we can see, the stock has moved up to 33.15. We are now deeper in the money with this initial setup. And of course, we're looking to make the 1.2% return if we're assigned. We still have our good downside protection in place on the, oops, sorry folks. Sorry about that, knocked the phone off. All right, and we still have a reasonable cost basis on the position. Now, what are we going to look to do for covered call management? Well, if the stock is up, we're going to likely leave this alone, aren't we? Let's be honest. We set out originally to make a 1.2% in a 15-day period. The stock is above our strike price by a fair amount. So we're going to look to take that 1.2% return, be assigned, and move on. Now, you could consider rolling the covered call up in strike and out in time to remain in the money. So, with the stock at 33.05, 33.15, I may look to roll the 31 up to the 32 strike, but only if the trading plan is met. I don't want to roll for the sake of rolling, meaning that roll to a new call where I'm not matching my initial trading plan of maybe at least 0.7 or 0.8% for a 7 to 10 day trade, or maybe 1.2, 1.5% for a 14, or again 2% or 2.5% for a monthly position. But that's one scenario. What if the stock had fallen in price? Well, I would treat the covered call in this case as I would a spread position, meaning that if I had opened a bull put credit spread on GT, and instead of selling the 31 call, I'd sold the 31 put and bought the 30 put, I'd probably look to manage that spread if the stock dropped and was trading within 1% of my short call strike price. I'm sorry, in this case it was a 31. So if the stock, I'm an in-the-money covered call trader, and the stock drops down to, let's say, 31.30 within about 1% of my short call strike price, I might look to roll the position down at that time to stay in the money, to keep the protection, and I'll probably still be able to retain the current return that I want, even if I have to roll out further in time. Okay? So things to look for is if the stock drops around 31.30 or half of the ITM range. When your trading plan entered, you may be using delta. You look for a minimum delta of 0.7 for your in-the-money call, or 70. You may have looked for a probability of greater than 70%. Or you might have looked to be at least 2.5% in the money for a weekly trade. In this case, our option was 2.8% in the money. So I may look to roll down if it's half of that. If now my call is only 1.4% in the money, that might be a trigger point. So I want to keep that minimum 2.5% range for the higher probability of being assigned, perhaps. Maybe if the delta drops. All right, I was started at 0.7 to be in the money, or 70%. Now if it drops down to 50% or 55%, I may consider adjusting it to try to keep that 75% probability as well. But the other thing that we have to address that I don't know and I can't address, I know my approach for these things, for the covered call entry, but in addition to that, you're going to have other criteria. We talked about delta, but what about the technicals? You may have looked to open a position, and you'd only enter a covered call if the stock was trading above its 20-day or 50-day moving average. Or maybe use 9-day or 15-day EMAs, exponential moving averages. Or use MACD for your stock selection. Or other things, Williams percent R, different oscillators, fast or slow stochastics, for example. Any of those technicals that you would use to enter a trade that would be your basis for opening a covered call position, you would also use as a trigger point. If I open position stocks, for example, for a covered call trade where it has to be above the 20-day moving average, if that trend reverses while I'm in the trade, I'm going to look to adjust the position for better protection, or roll down the position to stay in the money, or maybe liquidate the position now that it looks like the stock is moving against me as well. Okay, so you're going to look to adjust or protect any technical information that you use for the stock when entering a position. If it reverses, that's going to be a trigger point for you. And of course, the main criteria as well. How deep did you want to be in the money to begin with? What was your delta or your probability? When you see that lose 50%, and what I mean by that is, well, not even 50%. So if I open the covered call with a probability of 75%, I'd probably look to roll it if my probability or my delta dropped to 60% or maybe 0.6. I want to try to keep that trading plan in place for my positions. I don't want to overtrade, but if I'm concerned about the stock and I see some of my technicals have been violated, have reversed, and everything on my call now is different, that's when I might look roll down to protect you. So the question is where to roll to. Well, if the stock's up in the money scenario, let's be honest, like I said, we're probably going to let it be a sign. That was our game plan all along. We're looking really good. But if you want to try to lock in extra profit by rolling up and remaining in the money, you want to keep to your trading plan. If it doesn't match your trading plan, then I wouldn't do it. We would leave it alone and allow assignment, or we could liquidate early if the profit goal has been met for our position. If a stock gaps up when you're in the money covered call, let's say it moves up 8% from an unexpected event, you're probably close to the maximum return you expected on the position. You could liquidate early and take the profit. In this case, if GT did go up to, let's say, $36 over the last week or so, I'd probably be at intrinsic value with my December 23rd call. I could liquidate the position, take at least 85, maybe 90% of my expected return off the table now, and look to open a new position. One thing I want to mention here, I do get this question from covered call traders. When a stock's that deep in the money, it gapped up and you say, hey, I was going to make my 1.2% return, but I want to make more because the stock looks really strong. Should I allow it to be assigned and buy back in? Well, in that case, you might be better off just rolling the call. If there's not a lot of time value left on it because implied volatility increased. If that call is close to intrinsic value, rolling it up, you might save at least one commission rather than letting it get assigned and then having to buy back the stock and sell a higher strike call because you're still bullish on the stock. You might be okay to just roll it up. The math will come out the same if your call has less than, let's say, 0.2 or 0.1% time value remaining now that it's deep in the money, even with 7 to 10 to 15 days remaining to expiration. So I usually look to roll it rather than, hey, I'm still 10 days out, let me just keep it to assignment. I'm going to buy back in at this higher price and then sell another in-the-money call to get another return. I'd rather just roll it in that case and just do the one commission for rolling at my broker rather than waiting another 10 days to take assignment, buy back in at the higher price, and sell another in-the-money call and pay extra commissions. Okay. All right, what if the stock is down? Well, remember, we wanted to follow our trading plan and our trigger points. Okay, gaps will happen. That's the curse of a covered call position. 22% of you, I believe it was, said that you're looking for a different strategy because of the losses on the covered call. I understand that, and I feel sympathy for you. And it happens to the best of us. It really does. Even with cash secured naked puts, where you think you can go further out of the money, the stock needs to drop 10% before you're going to be put the stock. Sometimes stock can gap down 20, 25%. We're looking at a 15% loss, where on average we're only making 1% per month. Well, that's going to take 15 months to get back to break even. That's what we're trying to avoid. Okay? So again, once your delta, probability, option premium, technicals, once those are violated, look to roll down the position with the in-the-money covered call. Well, with strike, okay, well, in my opinion, the strike you'd roll down to is the same one you would look if you're following your trading plan and you're opening a new position. The covered call that's still offering the minimum return for your position, the delta you would typically look for as an in-the-money covered call trader, and still has the probability. Now let's take a look at the scenarios here. For both the winning position that we showed with GT, and we're going to show a losing position. And we show the losing position, what we're going to talk about, of course, is what would we look to manage now that it's gotten away from us as well. Okay, so let's navigate over to power options very quickly. And what we're looking at here is our portfolio tool, which we use to track and manage these positions. Now, we have a fossil position entered in here as well, but let's talk about our management techniques for Goodyear Tire and Rubber. Remember, we originally entered the position at 31.89 on December 8th. We sold that 31 call, collected $1.25. We were looking to make a max 1.2% return. Now the stock's wavering at about $33. It was at $33.05 earlier, and now it's at $32.90, so it's bouncing around, but our call has increased in value by about 77, 80 cents or so. Okay, so again, this is going the way I want it to. I will likely take assignment. But some of you might say, okay, well, 31 call is now deeper in the money. Why don't I look to roll up to the 32? Maybe a week out to December 30th, maybe 2 weeks out to January 6th. So I'll look to roll to that position. But is that something that's going to match our needs? Well, let's take a look. whenever you're tracking the positions here, we're going to do some of this heavy lifting for you for rolling out and adjusting positions. I'm going to go to position actions from the portfolio to position analysis. This is going to give us a breakdown of our covered call position. Now, what did we talk about when the covered call goes in the money? We started with an in the money call hoping to be assigned, which we're probably going to take on GT. But we knew that, hey, we might be able to roll up to get more profit out of the position now that it's been showing strength. We might be able to liquidate now if we've met our goals on the position. Remember, I said here that the best time to maybe roll an option is when it gets deeper in the money, but your time value is less than maybe 0.5 or 0.3%. Here our time value is still at 1.7%. Now what does that mean? When we take a look here, and I'm actually not near my trading goal, am I? We're still in the money, but if we liquidated the position now, bought the call back for about, was it 290 or so, and sold to close the stock, we're actually at a loss. Earlier this morning, this was only at a 0.1% gain. It's about a $2 monetary profit, 2 cents for 100 shares, but $2 monetary profit with the call being in the money. So liquidation for this position is not an option. If I could liquidate today, sell to close the stock, buy to close my call on GT with the in-the-money covered call, and I could make 1.1% return, about 90% of what I expected to make, I might take that off the table instead of holding it for the next 7 days. But we're nowhere near that. We're actually at a loss at the natural ask price, so that's not an option. Of course, we know we're going to make 1.2%. If we leave it alone for the next 7 days, the stock remains above 31, so we'll make that 1.2%. It looks like a good opportunity. But now we have to ask, if my goal was to roll up because I want to make extra profit, is it worth it to roll the position at this time? But we have to reflect on our trading plan. So a 15-day trade, let's say for 14 days, my in-the-money goal is to make a 1% yield, still have about a 2.5 to 3% downside protection, which we originally had, and about a 70% probability. Well, here we see some rollout opportunities. And my first thought would be, hey, maybe I could roll up, buy to close my call right now. I'm sorry, it's at 245 to buy to close the 31 call. And with the stock at 32.90, maybe I wanted to look at the 32 strike. Well, December doesn't appear. December 30th, where I was looking to roll out to. Neither does January 6th. In fact, the 33 call shows up, but that's out of the money. The probability is not where I want it to be. It's only at 47.8%. I'd want to stay with the 32 strike, which still has 70% probability, but take a look. If I bought back my existing call at 245 and we sold to open the 33 at 70 cents, we have a negative adjusted net credit. Okay, so we'd be rolling for a debit, and we're only making 1.9%. And this is 21 days from today, another 14 days from my position. So it is on the cusp, isn't it? Remember, my trading plan is to make around 0.7, 0.8% return. Here, if we rolled, we could make 1.9% if we're assigned at 33, adding an additional 14 days from where we are now. So it's close, but I'm not near the probability I want. And it's okay to roll for a debit. We'll talk about that a little bit later. But in this case, it doesn't satisfy my needs. In fact, the only one that does is going out 28 days, but I'm not near the probability. So why didn't the December 30th 32 strike that's still in the money that would have close to that 70% probability we want appear in the results? And it's because it's not increasing our return. So even if you rolled out to the 32.5, this offers 50-cent strike differences. Even if you rolled right now to 32.5, you're only gaining 0.1% for an additional 14 days. That's nowhere near our trading plan. I would not roll to this option. Okay? And if this is only gaining 0.1% from what I could make in the next 7 days, that means the January 32 is giving me less than that. Just based on the buyback cost of my current option, what the market's offering for that 32 strike, I'm not going to gain anything more. Let's take a quick look at it. Okay? So I'm going to simulate this. This is the profit and loss chart of what's called the custom spread tool in Power Options. And based on our prices, let's simulate buying to close our existing option. Okay, we can get a little bit better here. So let's say that instead of 245, we get midpoint here. Let's call it 205. Okay, so we're going to buy this back at 205. And now we're going to sell to open the January 6th 32 strike call. We're only going to get about $1.35 for it though. Okay, so total, we're taking in about 255, and we're buying back in 205. So we're still going to get a 55-cent positive premium. Oh, my apologies. Let's do that correctly, shall we? Yep. All right, try that again. My apologies. Let's add that back in at our buyback cost of 205. We're just going to look at the numbers real quick, and then we'll talk about the negative view. All right. Let's do it this way. We're going to add 80 cents. Based on the two options, let's just add 80 cents here. And I selected to buy the wrong one. Okay, there we go. All right, that's better. So this would still give us an increase in return if we could get the midpoint prices, okay? But it didn't show up initially because if we got the worst prices for this position, based on that wide bid-ask spread, if you got closer to 220 or 240, your return would be less than 0.5 or 0.6% for your trading plan. So the key to remember is don't roll for the sake of rolling. In this case, based on what I saw for these rollout opportunities, my trading plan is not met. I'm leaving this alone. I'm going to let it get assigned. If I could roll up to the 32 and I could keep this 1.2% for the next 15 days going out to January 6th, for example, that would be a good roll. I would take advantage of that. If I could get my new return up to 2.4, 2.5%, that's still within my trading plan. Usually 1 or maybe 1.5 commissions, depending on your broker, to roll the call, rather than letting it assigned and then buy back in. And we're doing it 7 days earlier as well. Now, let's talk about the terrible scenario. All right. The second position I've added, which you see the alerts have been triggered. Set alerts here in the portfolio for if the stock dropped below my 20-day moving average or if I hit my lower strike price. Let's take a look at this position. Back on December 8th, we could have opened a similar position on Fossil. Stock was trading at 34.62. Could go in the money. Again, 15 days out, the 23rd of December call at 225. So this gives me a very strong downside protection for the Fossil position. We do have about our 70% probability as well when this position was open, and we're looking to make a 1.9% yield if the stock is assigned. However, the stock did terrible over the course of the last month. Here we see the basic profit and loss, the stock chart for Fossil. Here would have been our entry price on or around December 8th, where we had a little decline, but it looked like it was moving back up. We had some positive MACD. The stock had bounced up back above its 20-day moving average. I could add that in for you, you'd see it. But then the stock gave us a rope-a-dope. Okay, it started to fall. Now here we're in a position where we sold an in-the-money covered call and got good downside protection. But the stock just dropped about 11% since we opened it. Okay, we're at a loss on this covered call trade despite the fact we sold a deeper in-the-money premium. Now let's take a look at where we are right now. Let's go back to the Fossil position. It's down 12% even right now. And I have made 80%. What I expected to make on this call is now out of the money. Once again, let's go to the position actions menu. Okay, so here we are. There's our profit and loss. We still have some time value left in the price. We only got a delta of about 0.1. Liquidation value is the loss of 8.4%. When that time value decays, even though we started in the money, had a good downside protection, it is a 12% decline, and we're looking at a 5.9% loss on the trade. Okay, now, as before, we're going to see some rollout opportunities. This is more defensive. Remember, our original goal was we wanted to be about 70% or so in the money to get a good probability. Want maybe at least that 1 to 1.1% return We want to keep a reasonable downside protection, maybe around 3% or so. Okay? Well, where's our stock? Our stock's trading at 30.46. Here, we see a problem, don't we? All of the opportunities in the near term, January 06 to the 30 or the 30 and a half, slightly in the money call, even down to the 29 and a half for the 13th of January, the 29 call for the standard expiration, we're still locking in losses. Okay? And honestly, I don't want to liquidate maybe right now on the position if I'm taking an 8.9% loss. And if I wait to expiration, you might say, oh, well, I could, if I'm only going to take a 5.9% loss in 7 days, I can hedge that a little bit by rolling out. And you're right. So here we're in a dilemma. Where can we roll to protect to? Well, we see some positive numbers down here. We could roll to the January 32 strike for the 27th of January. It's 42 days out in time. Get $1.20 for that call. We still keep out a 7% downside protection, but this 0.1% return is based on the stock coming back up to 32. You're stuck at 37.5% probability. So we're in a dilemma here where even if we go out to March, which is 91 days out in time, by the way, you're still keeping a positive net credit. You're not rolling for a debit. You know, we took in $225 originally. It's going to cost us $80 to buy back, and all these premiums are well above that 80 cents. So we're still rolling for a credit in all these situations, but because of the decline, we'd have to go out maybe 90 days to the at the money strike, slightly in the money strike, to realize a premium, a positive return if assigned, or the higher strikes, which have a lower probability in our range. Okay, so we're not seeing a rollout that matches our trading plan. Why? Well, the stock has fallen too far. Okay, so now we have to take a consideration. Let's go back to the trading plan. Remember, we entered the position on December 8th, and I did not want to overtrade the position. But we got into the stock at 34.62, and we sold that 33 strike. So when would I look to maybe roll this position? I would have looked to roll this position when the stock got within 1 to 1.5% of my short strike, or drop just below it. And we'd want to keep in the money. So even though it was only 2 days into the trade, I'd stick to my trading plan. It's tough to do, believe me. What do I mean by that? I just opened the position and the market or the stock didn't do what I wanted to. It pulled back. Okay, it dropped, a couple percent, maybe 2 or 3% since I opened the position. But now my in the money call is at or slightly out of the money. That's another trigger point. I'd look to roll at that time to better manage the position. So in this case, on December 12th, let's just take December 12th. There we go. I'm going to go to the option chain very quickly here, okay? My apologies for fossil. And let's go to December 12th on the chain. And what we're going to look at here is on December 12th, let's just look at the 23rd expiration. Still 11 days away after we open the position. Our 33 call went a buyback of maybe about $1.10 or so at midpoint. Okay, so we took in $2.25. We'd look to buy it back for $1.10. We could have sold the 32 at about $1.40. So in that case, if we rolled down here, stayed in the money, well, not really giving us what we want, is it? What do I mean by that? Well, I wanted to stay in the money. The time premium's good at about 2%, but I'm only at about a 58.6% probability. Maybe I should have rolled down at this time to the 71. I'm sorry, the 31. Okay? So maybe we buy back the strike here. Again, we're going to do it at 110, and we're going to sell this. Let's call it a 40-cent bid-ask spread. So let's say we can get 215 roughly for this position. That'll be less than that. Let's call it 210. Okay, so we're going to sell that for 210, the 30 strike. Let's roll. Let's keep in the same month, and let's roll down now that our position has moved against us. Okay, so we're going to simulate that. here on Fossil, back on December 12th. I'm going to roll the leg, change the date here, because why? We hit our trigger points for both the strike, stock moved below the 20-day moving average, whatever technicals we would have used to enter the position. So we're going to buy to close this at 110, and we're going to sell to open. We're going to keep in the same time frame because it was just happened 2 days after we entered the position. We're going to go to that 31 call and collect 210.205 on the position. Of course, stock at the time of trade was about 32.90. Fell below our 33 strike. Let's take a look. All right, now that we've rolled the position, lowered our cost basis down to 33.47, might get assigned at 31. Was this a positive roll? Let's go to the profit and loss chart very quickly. Okay, so this wasn't a positive roll. I wanted to show that because that's what I would have considered doing. But again, I wouldn't have rolled to a point where I'm locking in the profit. You may think that's obvious, but this is very important. Part of the trading plan, of course, has to be that your return still matches in addition to the probability. Don't roll for the sake of rolling, even to your own trading plan, unless all conditions have been met. This gave you a better downside protection. The stock could still fall further before you started losing money on the position, but now there's no potential for a gain. I'm going to point you to something real quick. We are at 12:51, probably going to go 15 to 20 minutes over. We want to talk about the out-of-the-money ideas and the at-the-money ideas as well, which are all very similar when rolling a position. Later on, if you have time this weekend, what I want you to go is go to our free webinars page, okay? Because I'm going to show you something right now, but I'm also going to show you a better idea. For these positions where your stock has dropped, whether you were in the money to begin with, 4 or 5% for our fossil trade when we went in the money, but the stock has dropped 10, 12%, and you're looking at a reasonable loss of 5% or 6% on the covered call trade. Remember, if I'm only making 1.5%, 1.2%, or let's call it 1% on the weekly trades, taking a 6% loss is going to wipe out 6 or 7 previous wins. It might take me 6 or 7 positions to get back to break even just from that one loss. That's the curse of the covered call position. But here, I sent you the link, powerup.com/webinars.asp. Under the options concept section, there's a webinar on manage your broken position. Now this talks about alternative methods for managing a stock that's fallen in price, a covered call that's moved against you by more than 4 or 5%, or of course a sold put is in the money. So most of this presentation, a good portion of this presentation is going to help illustrate what I'm going to show in a moment. What did we know about our original fossil position that was in the money? Well, we sold it when we got into that original position. We had the stock at 34.62. We sold the 33 call for 225. We saw a buyback right now of about 110. Right? So we still keep a $1.15 positive premium. If I close the position right now, I'd still keep a $1.15 a positive premium. So I'll buy to close it at 110. My new stock cost would be about $33.47. Okay, that's the new cost based on the stock if I buy to close the call. This is a situation you may look to do. If your stock has dropped 8, 10, 12%, you don't see an opportunity to roll down for a positive gain and still remain a decent range in the money based on your trading plan. I personally am not a fan of rolling out 90 to 120 to 150 days. I know some covered call gurus out there teach that. I think one of the terms used for it is called the slingshot. Or now that the stock has dropped, I'm going to look to go 6 to 8 months out in time and roll to that in the money strike that has that 65, 70% probability I wanted and roll for a high premium and have a positive gain. The problem I have with that is that the positive gain might only be 2% on a position where you're not going to realize that 2% profit for 160 or to 180 days. That's not matching your trading plan. That's less than 0.15% per month, okay? That's not going to, or less than 0.2% per month. That's really not going to get you where you want to be. There are alternatives. So one of the alternatives that I might use is what's called the stock repair whether I did an out-of-the-money covered call, an at-the-money covered call, or an in-the-money, where I'm now looking at probably an 8% or more loss on the total position, including the premium I received and the downside protection. So I may be able to use the stock repair to help me get back to break even faster. This is a simple tool, but it's kind of a complex trading idea. I'm simply going to put in our new cost basis of $33.47 and the fact that I have 100 shares. What this tool is going to do is try to calculate a ratio call spread for me, where I'm going to sell twice as many calls as I'm going to buy. So with 100 shares, I'm going to look to sell 2 calls and buy 1, looking to do it as a credit and see if I can get back to break even. Now, I was hoping to see something in January with this strike. It tried the 30 and the 31, which could be done at a credit, but it doesn't get us back to break even. Again, something interesting here. We see repairs in March. But what I like about this, remember, is the stock's trading at 30.30. If we had rolled down, as we saw, to that 31 strike, or even the 30 strike, we were locking in a loss on the position. Even out to March, 91 days away, we were only looking at a 0.1% return. Well, here's an opportunity out in March, building that ratio call spread by selling 2 31 calls and buying 1 30 call, get a $1.90 net credit, so your break-even's at $30.79. Okay? Maybe not be the best repair. Let's take a look. I'm going to analyze trade. And let's see what we've got here for the stock repair. Okay? All right. So here we see we could sell 2 31 strike calls at $2.95. So we're going to take in about $5.90, and we'd only pay $4 to buy the 30. So there's our $1.90 net credit. And here, if the stock recovers, moves back above 31, we could make 1.4%. Well, that's better than rolling the covered call could give us. It's at least a positive return and not a 0.1% return. Of course, it doesn't address the downside. The downside is still open. Could you do this in an IRA? Potentially, but it depends on your qualifications. This is a ratio call spread. I sold 2 calls and bought 1. But if you do it in the context of owning shares of stock, remember, your broker would just see this as a covered call, one of the short calls against your 100 shares, and a bulk call debit spread that you're receiving at a credit of 190. So this is an alternative to just rolling down the call and still having to manage it. Remember, most of the calls we saw rolling down to were locking in a loss, even if the stock stayed above your strike price. Here, unfortunately, it was only out to March, but a lot of times you might see a January or even a February repair that's closer in that could get you back to a profit. Even acknowledging that I have a 7% loss in this position because the stock's down 12%, I can now take advantage of using the at-the-money calls here and a ratio call spread to get back to break even faster. Okay? There's something else I wanted to show you very quickly on that page. We typically would want to do a repair at a credit. Sometimes it's not available. But we see here we do have January repairs available at a debit. So we could do other ratio repairs where if we thought the stock was going to recover and have a small profit, the stock went back up to 32. Our break-even's 31.86. Not the best break-even because we're adding a debit here of 25 cents. But again, doing it at a debit with the January 30 and the 32. It's a small debit there of we saw about 10-15 cents. We could lock in a return of 0.8%. Again, the stock would have to be trading above 32, but our break-even's 31.86 now. All right. So I'm not going to go too in-depth into ratio repair. I'm going to encourage you to take a look at that webinar underneath the options concepts for manage your broken position. Okay. All right. So let's talk now a little bit more about the other positions. The same type of rules would apply. You wouldn't accept much premium, but for an at-the-money option on December 8th for GT, we could have sold the 23rd December 32 strike for 60 cents. As we talked about with our trading plan, we have a much higher potential return if assigned, reasonable downside protection, but we start off with only that 47.5 probability as well. Similar profit and loss chart, we know that. Now, with an at-the-money covered call, if the stock's up, probably want to let it ride and take assignment. We'd make that 2.3% return. We were a little speculative, took that 50-50 probability, and it panned out for us. Is it worth rolling to a higher strike price? If I thought GT for the next week or the next 2 weeks was going to continue to move up, would I be able to roll and increase my potential return? Now, I'd only do it if it matched my trading plan. Using an at-the-money call that is now in the money, you will be able to likely increase your time value. What do I mean by that? Well, we took in that 60 cents, which seems small, for the at-the-money covered call at the beginning. It was a good percentage return, 1.8%, 2% premium at-the-money call against the position. But now that call is in the money. With the stock at 33 or 32.90, it might cost us $1.20 or $1.30 to buy it back. Remember, roughly 90 cents to $1 of that is intrinsic value, which we have in the stock. So the time value, we collected 60, we might only be paying 30 or 40 cents of time premium to buy to close this call. And then, of course, we could sell the higher strike 33, the at-the-money call right now, to get a better return. Typically, rolling an at-the-money covered call from the start with this type of movement, where it's moved up about 1 or 2 strikes since when we first got in, you'll see a better benefit of rolling the at-the-money call, the original at-the-money call, rather than if you had started in the money. Of course, that in-the-money call in GT, we're just going to let it get assigned most likely. And what if the stock drops? Same principles apply. I'd look to roll down for protection if the stock drops to the next strike. In this case, I will kind of follow the stock price. We mentioned earlier about the technicals and fundamentals. I would still use those as trigger points. But I started at the money with a 32 strike. Remember what happens when we sell the at-the-money call. We're looking to maximize the time premium. So now that the stock's fallen, our 32 strike on GT is out of the money, if it falls, okay, which is the fossil position. But this on GT, if the stock fell, now the 32 is out of the money, I can buy it back more cheaply, and I could sell the 31 call with the at-the-money time value for a better premium. Of course, if there's a sudden drop, we've made 80% of what we expected to make on the call, that's when we look to buy it back and maybe get out of the position, look to protect it by rolling down further, of course, as well. I started off at the money, 50-50 probability. So when the triggers are hit, where to roll to? Now, like I said, for an at-the-money trader, I'm going to go to the next at-the-money strike price if the stock falls or moves up. I want to keep at the money to maximize the time value. But again, it has to match your trading plan. And you'd use other criteria as well. If your SMA, your EMA, your delta, whatever you used originally to open the position, if that's violated, that's when you would look to adjust it as well. All right, very quickly, let's take a look at our 2 at-the-money positions, the one that's good and the one that's bad. Let's keep the same stocks to kind of keep it simple with the same prices, just the different strikes with the same expiration. Remember, GT here, with the at-the-money, when we got in the stock at 31.89, we might have sold the 23rd December 32 strike, 60 cents. This gave a max return of 2.3%. Right now, we could liquidate for a 1.4% gain, and at expiration, we're going to make 2.3% if the stock stays above it. Is it worth it to roll what was once an at-the-money strike and had a decent time premium on the position by buying it back now that it's in the money and going to the next at-the-money strike? We're going to still consider that 33. All right, let's take a look. Once again, I'm not going to do the math. I'm going to let the computer do the math for me. Let's go to position actions and position analysis. Oh, Mark asked, is this being recorded? Of course it is. And I'm going to post it in that webinar section under the option strategies. I know I'm going a little bit over, Mark, and I do apologize for that. I wrap up in the next 10 minutes or so as well. We just wanted to take some looks here. Remember, my goal is a little bit different. With an at-the-money trade, instead of looking for maybe that 0.7, 0.8% return for a 14 or 7-day trade, I would have looked for about that 2, maybe 1.5, 2% return, and we're there if we get assigned. Hey, I'm almost there at liquidation. If I've met my goals, 1.4% for a 7-day trade, we might liquidate this position right now. But remember, I want to increase my return by 0.7% if I'm going 7 to 10 days out, part of my trading plan, or maybe closer to about 1.5 to 2% if I'm going 14 to 20 days out in time. So 7 days from now I could make 2.3%. Does anything going out 14 days increase it? And the stock's at 32.88. Absolutely. We could roll to the December 33 strike. Now this is rolling for a debit, even break. We took in 115 originally. It's going to cost me 60 cents to buy it back. And I could sell to open the 1 week out from my expiration, from the 23rd of December to the 30th for 55 cents. So we're at a wash here for the net credit. But it does increase my return from 2.3 to 3.5 for only 7 extra days. If my expectation is that the stock's going to move up and it's going to stay above 33 because I'm bullish, I've added 1.2% return for 7 days extra of trading. I'd consider that a good roll, okay? That's one that I would consider. Do you have to roll for a credit? Not necessarily. Here's rolling for a January 32, going 14 more days out in time, and rolling for a credit of 75 cents. But it only takes the return up to 2.8%. So I'm adding 14 days to my next expiration, and I'm only gaining 0.5%. Doesn't match my trading plan. Rolling for a credit might not be necessary. My trading plan is not met. Now going to the 32.5, really the 33 to roll for a credit here to stay at the money, going 14 days more out in time and gaining 1.7% is close. Okay, it's really close. But I think here, rolling for slight debit or a wash and potentially getting a 3.5% return, increasing my goal from 2.3 to 1.2 for only adding 7 days, that might be a good adjustment if I'm wanting to roll. If I'm fearing that I'm going to be assigned early, this would be an adjustment I'd look to do. Okay, because I didn't want to be assigned or I want to say at the money, that's what I would look to do as well. Okay, as far as the at the money goes. I don't think it's necessary to roll for a credit if your goals are met. That's what's important, your return, the end result. Rolling for a debit might be okay in different situations. Perfectly fine as long as your target goal is met for your trading plan. If you're not keeping to your trading plan, what's the point of, what's the point of having a trading plan? Excuse me. That's sort of the key, okay, that we want to look at here. Now, let's take a look at our evil position. Let's take a look at the fossil position. Different kind of setup. On December 8th, we again would have looked to purchase shares of fossil 34.62. The at the money 35 had a premium of 105. This would give us a 4.3% return if assigned, with reasonable downside protection of about 5.5%. Looked pretty good for a position. But here we are, 12% down. What would we look to manage this position? Well, again, same rules, but in this case, let's go to position analysis one more time. Now that the stock has fallen in price, our buyback cost is only 50 cents. Okay, so we made about 50% of what we expected to make on the position. The liquidation and the loss are bigger now because we didn't collect as much premium as we did with the short call, almost within the money covered call. Okay, so we're at a significant loss here at 10.3%. Can we roll to make it better? No, nothing in the short term. And nothing going further out in time. Nothing becomes positive. We're here out to January. A lot of different strikes here. First positive one we see is 42 days out in time. The 33.5 strike. It's only 0.2% potential return. That's not at the money. That's more out of the money because it's taking into account speculation. March 30 call still puts us at a 2.8% loss. Okay, can't be rolled for credit. The March 32 gives us a potential 1% yield, but it's only if the stock recovers to 32. This is a position where I would consider buying back the call now at 50 cents. It's only going to take my cost basis down to 34.12 and looking to potentially apply stock repair. But again, this would have been a better position. This would have been better managed had I followed my trading plan. Here we got into the stock, remember, and we sold the 35 call. Here. Yep, that's okay. But as it dropped, here I might have looked to roll down to the 33 strike and then roll down to the 32. I'd follow my trading plan in this case. I don't know if I'd roll down to 31 at this point, okay? But here in this case, we'd be lowering the cost basis effectively each time we roll down, because we'd be buying each call back for less and getting a new at-the-money premium to increase the time value. And this, I know it's only a 3-day, we would have rolled twice in a 5-day span. But it's better to do that than wait for the stock to decline 10 or 15%. I'll be honest with you. Another approach you have to consider is any covered call you enter that's at the money or out of the money, you may want to consider liquidating the position with a stop order. It's not guaranteed. You can still get caught in a trap and still realize significant losses, but you may want to set that stop 5 or 7% or so. If the stock falls 7% from when you entered it, maybe just get out of the position. You still maybe collected 2% time value, 2% of premium, so your loss is only about 5%. You might be able to stomach that, but again, that's going to cause problems long term for you with the trade-off there. But that's what we want to consider too. That should be part of the trading plan, is exiting entirely if it's not doing what you want. But again, you can manage the position effectively. If you wanted to be an at-the-money covered call trader, you should consider rolling down if the stock goes to the next strike. Many of you noticed, so someone just commented on it, that, well, the at-the-money strike here was the 50 cents, meaning that GT and Fossil both offer 50-cent strike differences. I honestly don't pay attention to that. I use dollar differences. If it's a weekly series, it offers dollar strikes. If it's a $200 stock and it only offers $5 strikes, when I say roll down to the next strike when it's at the money, if I sold a 205 call, bought the stock at 204.50, and our stock fell to 200 or 199.50, I would roll down to the 200. Okay, I would wait for the next strike to roll it down to make sure I'm paying less to buy back that call, to roll it down to the lower strike. Keeping it at the money, keep with whatever trading plan you decided with, is a good idea. Now, if you're concerned about the market as a whole and you're expecting a pullback, well, as an at-the-money covered call trader, you might want to roll to in the money for better protection, or get out of the positions. Don't do a covered call strategy in that case if you feel the market's going to correct, or convert it to a collar position so you have a guaranteed locked-in loss to the downside and can't lose any more than that as well. Okay, but this, again, the Fossil position would be an opportunity, I feel, maybe to buy it back. Not even buy it back, evaluate the stock repair first. See if you can find a decent repair. There are other techniques discussed in the Manage Your Broken Stock webinar that you want to take a look at as well. But again, this is just an example of how it would have worked out better had we stuck with our trading plan as opposed to waiting for the stock to fall as much. And in addition to that, I do have to say that setting a loss, a liquidation of the entire position at about a 7% decline, maybe even a 6% decline, is also a good management technique. If you're in the money, open that up a little bit. What do I mean by that? You probably put in a stop at some time or another when you're doing in the money, but hey, if you've got 10% downside protection, you might be able to suffer the stock falling 15 or 17%. Because the 10% is already covered by the premium, so that extra 5% would reflect the true loss on the trade. But with the at the money and the out of the money, we have to be more careful. We can't allow the stock to get too far away from us, and we would have limited this loss by liquidating early. We also would have limited this loss by rolling down following our trading plan and going to the next at the money strikes as well. All right, so one more quick thing here. We'll wrap up. Earl asked a quick question. Are you planning to touch on leap diagonal spreads in the next few weeks? I can. It'll probably be 2017. I don't know if I won't get to it next week. Maybe the week after, Earl, we'll see. After we do the covered calls, we'll jump into those as well. Okay? Meaning that, I'm sorry. Not today, it's just after we handle this as well. All right. Now, the OTM covered call, what do we know? Well, it's really the reverse of an in-the-money covered call, isn't it? Remember, with the in-the-money covered call, we would see maybe about a 5, 6%, maybe 4% downside protection even with weeklies, and you only had about a 0.7, 0.9, maybe 1% return if assigned. Out of the money is the reverse. You only get about here, you expect about a 0.8, 0.9%, 1% downside protection, but you have the possibility of maybe a 3.5, 4% return if assigned. Okay, sort of the reverse of the in-the-money covered call. The downside protection is lowered because you're only collecting a smaller premium. Now, for a position like GT that's moved up, this is phenomenal. But the stock's, just above the strike price at 33.02. So as an out-of-the-money covered call trader, where you want to hold your stocks for longer term, and the stock moves up more than you expected, when would you look to roll the covered call position? Well, the fear is, let's say that we're trading something bigger, and I have a lot of customers that have this. Positions maybe in Google or Alphabet now, maybe Apple or Amazon. I talked to a customer yesterday who has several thousand, I think it was 3,800 shares of Apple with a cost basis of somewhere around $62.50 or something like that. Okay, so he's got about 100% gain almost in the position. It's close to it, about 92% gain on the position. Okay, well, he doesn't want to sell covered calls because he doesn't want to risk getting assigned because it's in a cash account. He doesn't want to pay the taxes on that. Okay, early assignment is not that frequent, but it can happen. This is a catch that I don't have an answer, and I get this question a lot. Should I expect my covered call to be assigned once it goes in the money? No, but it can be, and that's the key. It depends on what's going on with the stock, what's going on with the market maker, and how he's setting the prices and everything. Early assignment can happen. So if your goal is not to be assigned, we're going to look to roll that out of the money call. So in GT, we bought it at the price at 31.89. We sold the out of the money 33 call for 33 cents, about 1% of the stock price. So I may look to roll the position if the stock moves maybe 1% above the short call strike price. Why? It's because of something that we call the ATM bell curve. Okay, we already saw this when we looked at the chain in the beginning. The at-the-money covered call had the highest time value and the highest percentage time value as well. Okay, in the money and out of the money options are going to have lower time premium. We see that with the out-of-money. We just got the lower premium. The in the money option has a higher total option bid, but most of that's intrinsic value. So we want to sell options that are at the money if we're looking to maximize the time value, and we want to buy the option when it's slightly in or slightly out. I'm not saying there's anything wrong with doing the out-of-the-money covered call approach for you guys. Like I said, if you're doing it on a core set of stocks and it moves up, you want to avoid assignment, you're going to want to stay out of the money. But it might be better to let it go slightly in the money first. And that's not to say I want you to risk being assigned early, is because if you let the stock go above your current stock price, that gives the next out-of-the-money call more premium as well. You might get a better roll by buying your call that's slightly in the money now and selling the call that's closer to at or just out of the money. Here's what we're talking about. When you're looking at any chain at any time, when GT was trading at 31.89, that 32 call had the highest time value. 31 was made up of intrinsic value and time value, so it was lower in the time value, and if we went to the 30 or the 29, we're getting just about $3 in premium, so we're right at an intrinsic value of maybe 5 cents of time premium. Well, out of the money is obvious too. We see the 33 was only at 60 cents, and at the time the 34 would have only been 20 cents, and the 35 would have been 5 cents. So max time premium is here. Well, we sold the 33 to be out of the money, okay? But now that the stock has moved up, the 33 strike is at the money. It has the highest time value. 34 is low, 35 is low. Of course, the 32 has intrinsic value, but now time premium as well. So rather than buying at the max time value and selling a lower, if we let the stock move up a little bit, This time value is going to lower, and this time value is going to increase a little bit. Might be a better approach to allow it to go slightly in the money, even though you want to avoid early assignment because of the rule of the ATM bell curve. These are ideas and concepts of what we might look for personally, myself and Ernie, to manage the position. We usually let it go in the money a little bit. But again, I just have to remind you, if you're worried about early assignment because of tax reasons, because you don't want to lose the stock, because it's a main portion of your portfolio, well, you might want to roll that out of the money call if it gets close to at the money, meaning if the stock gets within 1 or 1.5% of the short call strike, you would look to roll it. We started with a 33 strike. So about 33 cents, it's about 1%. So when GT hit about 32.65, I may have considered trying to buy back that 33 and maybe rolling up to the 34 if you're really worried about early assignment. But remember, you're going to be buying back at the money, rolling the further out of the money, so you might pay higher time premium at that case. But you avoid the headache, the stress, and the concern about early assignment if you really do not want to have those out-of-the-money calls you're selling against your basket of stocks assigned as they move up in price. Again, Ernie and I aren't typically married to stocks. Many of you might be just looking for new covered call positions on a regular basis. We were hoping to get assigned or managed and try to get that return that we saw as well. And in that situation where you're not 100% married to the stocks, you're okay if they get called away, you might want to look. If you're doing out-of-the-money calls in that case, you might want to wait for it to get a little bit in the money so that you're buying back a slightly in the money call and selling a higher strike that's more at or just out of the money to get a better premium on the position. Okay. Now, we already talked about this. It's the same thing. What we talked about with the in the money, out of the, at the money, and for the out of the money. When the stock falls, it's a much bigger problem for those of us selling covered calls that are out of the money. We took in less premium. We had less downside protection. The losses are amplified. As we mentioned, this is more important to use the strike prices as your trigger. You don't want to overtrade, but you don't want to let the stock get away from you. And in the case of a large decline, that 12%, remember we saw a fossil down 12%. The in-the-money covered call was down about 7%. The at-the-money covered call was a liquidation of a loss of 8.9%. The out-of-the-money covered call and fossil, if we had sold the 35 call, we'd be looking at a loss of 11.6%. Okay, so that's not something that we really want to take on our positions if our average, remember, is only about 1 to 1.5% per month. We can't stomach that. So in case of that large decline, you have issues. So this is where you'd consider an alternative position. Okay, if the stock drops 4 to 5% and you're an out-of-the-money covered call, so I think it's more important to manage or protect your position. Consider an alternative position to protect the downside. If you roll down, make sure you're not locking in a loss. So so the fossil position, let's say we collected 60 cents of premium. We bought the stock at $34.96 and we sold $34.62 and we sold the 35 call, for $1. Right? So it puts my cost basis now roughly down to $33.47. Well, now the stock drops to 32. I buy back my call on the cheap. I roll down to a 32 strike, but I only collect 60 cents. My cost basis was $33.47. This puts me down to $32.87. If I get assigned at 32, if the stock did recover, I've locked in a loss. You want to avoid that. I mean, that's what those tools help you out with. You may have a large loss in your position where you don't see any positive value. You don't see any positive new return by rolling out to 20 to 30, maybe even 50, maybe even 91 days out in time, which we saw with some of the fossil positions. That's when you're going to want to consider the alternative. Evaluate if the stock repair works for you. Okay? See if that could put in your position. When is it a good time to consider a collar? When is it a good time to consider, okay, the stock's moving against me? Instead of putting in a stop order now, maybe I want to buy a put, which will hedge the loss if the stock continues to fall. So when is it a good time to consider a collar? When the stock drops 4%, when you were bullish on the stock, I'd say 4 to 5%, and you're asking yourself if you should buy a collar, that is the perfect time to add a put to convert your covered call to a collar, in my opinion. Remember, because if there's more decline, the stock is weak and it has a sudden gap down overnight, the stop order wouldn't protect you anyway, and you would have already locked in the loss to begin with. The put would hedge it from further losses. Yes, you're going to have to pay for it. Yes, it's going to increase your cost basis. But yes, you'd be able to limit the loss. Instead of getting near that 10, 12, 11% loss in the position, you could have guaranteed not to lose maybe more than 6 or 7%. And that's huge. When you're talking about doing the out-of-the-money covered call approach, we're only making that, generating, I should say, that 0.8, 0.7% return every 14 days, or maybe 1% every 20 days as well. Okay? All right. So in summary, the rolling techniques and triggers, in my opinion, depend on your covered call approach. Have a trading plan first of whether you're in the money, at the money, or out of the money, which one best suits your goals for your portfolio, and what you want to accomplish with trading. Threw a lot of numbers at you during the presentation. We showed a lot of rolling on the presentation, but remember what's key. Just don't roll for the sake of rolling. Make sure it matches your trading plan. Just because you see a rollout opportunity, you think, oh, well, I bought the stock, I sold the at-the-money call, the stock fell a full strike, I should roll down to the next strike. Make sure you're not locking yourself into a loss. Don't roll for the sake of rolling just because it's there. Evaluate the positions and try to keep as close to your trading plan as possible with the market conditions that are offered you. Do you have to roll a covered call up for a credit? Really, that's the only time it comes into play, is if you're rolling up to try to get more return. We already showed not necessarily. You can roll for a debit and still increase your potential return if assigned, the max return you're looking to make, or the goal on the position, without rolling for a credit. Okay? Make sure the return matches your goals. That being said, I have 15 years of options trading experience. Ernie has much more than that. He's since about early 80s, he's been trading covered calls. We'll say almost double what I have, 30 years. He prefers to consistently roll for a credit. If he's rolling a covered call up or a collar up in price, he prefers to roll for a credit. You can stay within a shorter time frame, not roll for credit, and still increase your return to match your trading plan. So rolling for credit, I feel, is not always necessary. Ernie prefers to do that, so I'm just mentioning that as if you ever talk to Ernie on the phone, you call up for a coaching session, you're talking about covered calls, he's going to point you to rolling for a credit, and there's absolutely nothing wrong with that. It does help with the cost of the commissions. It always good to see rolling down the cost base of your position if you can roll for a credit, but a lot of times if you're trying to roll a covered call that's moved up for a credit, you're going from a position that was originally 14 and might only be 7 or 5 days out in time now to almost maybe 60, maybe 90 days out in times. We saw with some of those March situations on Goodyear Tire that had moved up. And does that little return for going 90 days out, 3 months, is that going to match your trading plan? If it does, that might be okay. But don't feel you always have to roll for a credit if your trading plan can still be met. All right, well, we've kind of gone long here on the tooth, and I do apologize for that. If you do have any questions, since we're not going to have a lot of time here, I'm going to encourage you to join me at 4:30 this afternoon for our open discussion presentation. If you go to that website, powerup.com/webinars.asp, you'll see the next available webinar up at the top. 4:30 p.m. this afternoon is an open discussion presentation. You bring your questions. I don't have any planned material. We'll handle your questions on the fly. And Earl, of course, if you have questions about calendar spreads, you can bring them later this afternoon as well at 4:30 p.m. Eastern Time. If you have not tested Power Options, reminder, anytime you can simply go to powerup.com. You can put in your name and email address and click Start My Trial. All right, that'll give you full access to Power Options for a 14-day trial period. You can test out the patented search tools, which we didn't see today for finding new positions, but work with the portfolio. Check out that analysis screen to evaluate rollout opportunities and adjustments as well. We do all the math for you so you can quickly evaluate, is this rollout opportunity worth it for me, or should I wait, or should I just let it get assigned, or should I just exit? You'll be able to see that very clearly between the difference of the current liquidation value, the potential future expiration value, and in comparison to the rollout opportunities. So if you have not done so, take that 14-day free trial to Power Options. Those of you that are currently in power options, start using the portfolio to track your positions and evaluate the rollout opportunities. That's not just available for covered calls. You'll see that if you're tracking bull put credit spreads, bear call credit spreads, cash secured naked puts, long calls, long puts, all the other strategies that are there, you'll be able to see the rollout opportunities. And if you do have any questions, send me an email at any time to support@powerop.com. Remember, you can also call us during market hours at 302-992-7971. Well, I apologize again for going long. Thank you all for joining me today. I hope you did get some useful information out of today's presentation, and I hope to see you all soon at our next upcoming webinar. Good night.